All right. Hi, everyone. Thanks so much for joining. Hopefully, you can hear me fine and see me fine. I checked a few of my settings. If there are any issues at all, please don't hesitate. Just let me know in the chat window. And but otherwise, I think we're good to go. Awesome. Yeah. Thank you for the thumbs up. Really, any engagement on that chat window just makes me so happy. So thanks so much for joining me. Welcome to tonight's edition of my YouTube live channel. Didn't do one last week. I kind of needed a week off. Honestly, I was just really tired. I do feel that quarantine fatigue is a thing that I think a lot of people are working really hard, are kind of getting burned out, and really happy to just take my time with this. It does take a lot out of me doing these shows, so wanted to make sure I was in a good headspace. And now I'm a little better rested, in good spirits and good energy, and kind of ready here to answer all your questions. So I do have some questions. I got a bunch of great questions through my email, so really grateful for all those. Thank you so much. I will usually tend to sort of start off with those. But before we do that, I do just want to give a little bit of a market overview, kind of where we're at right now, couple little indicators. If there are questions, obviously throw them in the chat, but really the format's going to be to start with a market overview and then just jump into questions, and I'll stick around as long as people have questions. So, you can see in terms of today, a little bit flat, like the fact that the S&P 500, so this would be the US market, was up about 0.5%. The TSX, the Toronto Stock Exchange, was down about 0.5%. Like, this almost feels back to normal. It's not one of these wild swinging days. I don't want to jinx anything, but it feels so good to have a day that is like relatively flat. One thing I've been keeping my eye on, of course, is the VIX, which is the volatility index. So again, this is a good measure of sort of have markets calm down. And you can see here, we were kind of going along very nice and calm for quite a while. And then right at the end of February, this was sort of the peak coronavirus fears. And then you can see here right about mid-March, this is when I would say the fear and the uncertainty seemed to really peak. And then over the last month, the volatility index has calmed down. That's not to say that this thing is over, but what it tells me is that the markets had a really hard time absorbing information for the first little while, that it was really challenging to know what was going on. And that over the last month, there has been, I would say, this slower absorption of information. Also, we've started to see all these government stimulus packages roll out. And obviously those are having a bit of a calming influence on the market, kind of tempering things a little bit. In fact, when I look at the performance over the last 2 weeks, so I'll use this All Country World Index as the measure, you can really see that things kind of have bounced back up. That since a low on about March 23rd, we've seen the market really come roaring back. In a way, this has been, some of the best weeks in the history of the stock market in terms of this bounce back. And that really, when we look at this, if most charts, like if I go, let me just do the actual chart here for the All Country World Index. This way I can go back a little bit further. Let's go back a year. Oh, hold on. This is looking a little funny, I think, because I've got it probably flat here. Yeah, that's why. This is looking weird. Let me try this. There we go. So here's the 5-year chart. So really, in terms of the All Country World Index, we are back to, either where we were in sort of 2017, thereabouts, or, if you remember, there was that big dip in 2018, where right in December, where it dipped down and then jumped back up. So we're kind of at those levels. Now, the fear that I've got, and the sense that I've got, is that this little bounce back, right, over the last little bit, so the initial sort of broad decline here, and then the bounce back that we've had, I'm a little bit worried about this bounce back, because I do think that there is a little bit of what I'm going to call exuberance in the market right now. That what it means is that after the initial shock of the severity of the virus kicked in and those prices kicked into the market, what we've seen is a little bit of a return. meaning that I think there is hope and optimism in the markets that this isn't going to be a full-on like recession. I've even, we talked about the R word. Oh no. Imagine I was hearing talk about the D word, about a depression, which would be like the absolute worst case scenario here. And what I would say is that a lot of investors are feeling that that is not going to be the case here. I think there are two big reasons for optimism. Number one is a lot of sort of medical advances. We are starting to see a lot of treatments and testing, some really cool innovation coming out in terms of therapeutics and on the medical side of things, where if we can get a handle on this, if we can have massive testing, if we can have things like, in a dream world, it would be a vaccine. I think my understanding is that's a ways off, but I would say there are rays of hope there that there will be a medical solution that would get us, I don't want to say quite back to normal. I don't know what normal is going to look like after this, but it would get us back to a similar place to where we were. But the other thing that's happened is governments have really stepped up in a major way. And not only governments through stimulus and what we would call fiscal policy, but also central banks and through the form of what we would call monetary policy. So in the US, there's the Federal Reserve. So in addition to Trump and kind of giving everybody $1,200 and, Congress passed this huge stimulus bill, at the same time, really the Federal Reserve stepped up. And what they've done is done what we call quantitative easing, which is them essentially printing money, though you don't print it, but they are injecting money and putting cash into the system. The way they do this is by buying bonds. In the same way, here in Canada, the Bank of Canada just announced in the last couple of days that they are buying corporate bonds. So there would have been a few news stories about this, right? But this was just yesterday, really, where they're going to be buying a whole bunch of bonds. So if you remember, a couple weeks ago, I was a little bit worried about the bond market, and now all of a sudden, Bank of Canada providing a backstop, saying to investors like, "Hey, don't worry about the bond market. We got it. If you need to sell your bonds, we'll buy them from you." And in doing so, trying to expect a really sort of, bad dip there. So all of this is to say that, markets have responded very favorably. When I'm watching the news channels, when I'm reading stuff, they tend to be a little bit more optimistic. I don't quite share that. I'm still really nervous. I'm still a little bit not quite as, I would say, afraid as I was 2 weeks ago, but I'm still kind of afraid that really I can see this thing drag on. And what I'm really worried about is I think now we've sort of absorbed the initial shock. I heard a line that really resonated with me saying that we are at the end of the beginning of this crisis, that really that start of it, that initial shock, I would say is sort of tapering off or has tapered off. And that now people are looking forward to say, okay, what's going to come out of this? How are things going to react? What I'm really worried about are what dominoes are going to start to fall. And I'm seeing a lot of problems when it comes to the housing market here in Canada. Really interested in maybe doing a whole show and having some guests as soon as I can get my tech. But I would love to do a show on, the housing market and what's going on there. But it was really, really weird to see headlines of massive unemployment figures, like massive amounts of unemployment. But meanwhile, the stock market was bouncing back up. So that tells me two things. One of two things. Either it fell too far and the market just overreacted on the downside and things just dropped too far, right? And so a lot of people, okay, it's cheap now, let's buy it. Or that people are kind of being, I would say, irrationally exuberant. That a lot of people, when it comes to investors in the stock market, are saying, hey, we're going to get through this. It's not going to be so bad. Trump's already talking about opening back up the economy. They would be listening to that rhetoric and saying, okay, great. This is just going to be a little blip. It's not going to be a long drawn out thing. That said, I've got some concerns. Personally, I don't think we should be opening anything up right now. I would say keep it shut down. Let's really make sure that we do have those health solutions in place before we start putting more people at risk. But it's interesting to kind of follow that emotion, follow that dynamic. And what I would say is that although, it really was fear and panic for a little while. Over the last couple weeks, it has been more, I would say, exuberance and people looking for buying opportunities and, thinking that, hey, like this thing might bounce back quicker than we thought, which I don't really buy that narrative, but I think that's what the market is telling me. The last thing I do want to just show you in terms of the market outlook is just to talk quickly about the price of oil, because this is, again, something that I do follow quite a bit. And what's really interesting is that we did see the announcement of an agreement by OPEC Plus between Russia and Saudi Arabia and all these other countries. And they came to an agreement. And that was kind of one of the big conditions. We thought maybe that would cause the price of oil to jump back up. And it hasn't. It stayed really flat. Like if we look at that date was, that agreement was, 3 days ago here. And you can see there's some people saying too little, too late. And sure, I can't really speak to that. I'm not an analyst there. But what I do know is that that was roughly 3 days ago. And over the last 3 days, it has been really quite flat, which tells me that, the oil price really hasn't responded. If we look at the WCS, which is the Western Canadian Select, which is Alberta, we're looking at $7 a barrel right now, which again is still quite low. This did bounce back up on the good news, right, a little bit, but has now flattened off. So, I still have really big concerns about about the Canadian economy. I still have a lot of concerns about the stock market and kind of where we are. I do understand why people are getting a little bit exuberant and hopeful that we're going to get through this thing relatively quickly. But I got to say, I'm still sort of erring on the side of caution. And my biggest fear is that, it bounces back up here and it's all good news, but then we get more bad news and more bad news and more bad news, specifically around economic numbers, if not even just the biological numbers, and that could cause things to fall back down. It's always going to be interesting. I think this ETF was around, let me see if I can do max and if it'll give me the full. So you can see that here, this was 2008. And, there have been times where it did bounce back up. I don't know if it'll let me zoom in here. I think I'd have to go like all the way over here. Here we go. But if I can zoom in here, that there were times, after the initial crash, right? We're here, this would have been just about a week, but where it did jump back up and then fell further. And then jump back up and fell further. So it took a few times before we did really see a bottom. And so my fear is that, in terms of where we are right now, that this could just be a bounce back. Obviously, I don't have the crystal ball. I don't know. But, definitely going to be keeping an eye on this and reporting to you what I see. Let me just take a quick glance here at the questions here. Any ETFs for the suppliers of components and or solar systems or wind systems? I can address this in a little bit later. Yeah, I would agree, TAN, absolutely, TAN, and that really is going to be on the, that is going to be on the solar side. The other one, I'll just address this real quick, is, what is it, GEX. And, I guess now it's SMOG. Sorry, they updated the ticker symbol here. So this low carbon energy ETF, this is the renewable energy ETF I've seen that has the smallest allocation to utilities. So I can just show you this one, but SMOG, if I can get through all the agreements, here we go, should have a fairly small allocation when it comes to utilities. You're going to have to see whether this fits the bill for you, but what I can tell you, only 12% utilities, whereas a lot of them do have that sort of 30% allocation. So Rick, if you are looking on the energy side, I would say this SMOG one is what I refer to as the sexy clean tech ETF. I can jump into those a little bit more if you want. BEP, so this is the utility, and I can talk a little bit more about those utilities. Yeah, Brookfield Renewable, one of my top picks, has been doing really well for us. But I think here that Rick, if I know you, you're looking more for the tech side, less for the utility side. So if you have a question in the chat, you can get to it. But I do want to get to the questions that I got emailed. And specifically, I'm going to start here at the top because what everybody wants to know right now, the $1 million question, is around market timing. So here I've got from Ariana, I've got a question about the timing of investing. Who doesn't right now? Is this a good time to start if we are new to investing, or do I believe things are too volatile? If it is a good time, should we start with just a small amount? So really when it comes to this with market timing, again, my caveat that I don't have the crystal ball, I don't know what's going to happen, but what I'm doing right now is asking three main questions. Question number one is going to be, is your income affected by the crisis? And, I would say, obviously, some people have lost their jobs right away. And in that case, if your income has been affected, if your income is way down, don't. But also, you got to be careful right now, because what we're starting to see is, again, the dominoes fall. And we're starting to see a lot of companies start to cut back and let go of employees. And it might not necessarily be the companies that you would think. They might not be from an affected sector. But if they were just in bad financial shape before, let's say they borrowed a bunch of money or they raised a bunch of money and now they need to lower their burn rate, or they're a little bit worried, they're a little underwater. A lot of companies that even if you'd think they would be fine and you're able to work from home, I do think we're going to start to have job losses here. So really for me, I would be cautious here and look at not only your personal job and your personal income, but also look at your company, right? Or if you run your own business, look at your customers, and really to think that over the next few months, might they stop investing as much or spending as much? So that's really going to be number one, is your income. Number two is going to be your emergency fund. So do you have debt or an emergency fund? Right? And if people are in debt right now, if you've got a student loan, even if you've got like a big mortgage and these big hefty mortgage payments and all that, mortgage is like an okay debt to have. But certainly if you've got a line of credit or if you have any credit card money balance there, do not invest right now if you have any debt. And then I do want to make sure you have an emergency fund. And whereas I used to talk about having somewhere between like 2 months until 6 months, right? If it was 2 months to 6 months, that would be okay. That now I'm really talking about having 6 months to 12 months. That really I almost want to have you to have a full year of cash set aside to be able to handle any emergencies. So that's going to be the next question, really looking at your cash flow, and in the worst case scenario, if stuff does go down, are you in good shape? Hopefully you don't have debt, you have your emergency fund. And the last case is, the question is really, is it for the long term? That, if you're thinking about buying a house or a condo in the next 3 to 5 years, you should not be investing right now. This is way too volatile. Don't even go near the markets. Really want, maybe bonds, I would suggest just cash. Again, normally in the past, I would say at least a 3-year horizon, right? Now I'm saying at least a 5-year horizon. Because if the market does crash, it could take 5 years to get back to where it was, right? So if it's less than a 5-year horizon, don't invest right now. But if it's like for retirement and, you're young and you've got decades and decades, then hey, now is a good time to start investing. From there, should we start with just a small amount? So yeah, this is really what I've been suggesting to a lot of clients right now. And especially if it's a nest egg, that if you have like a certain amount of money and that's all the money you have, let's say it's like an inheritance or, you had a savings account and it kind of was like ballooned up. So now you've got like a big chunk of money. You probably don't want to do it all at once. This is where you probably want to use a strategy called dollar cost averaging. I've talked a lot about this in the past couple weeks. This is the idea of splitting it up and sort of doing it in chunks. The analogy I use is that we're throwing darts, but we're blindfolded right now. We don't know what's going to happen. So instead of throwing all of your money in one dart, split it up between 3 darts or 4 darts or 5 darts. You can do, 25% at a time, over the next few months. And what that'll do is reduce your risk of volatility. That if it does go down further, not a big deal. You can throw another dart and buy things when they're lower. That said, a lot of us do dollar cost averaging just by default, like just over time. This is what we do, is really using this approach. We're just going to save, right, every month, and then you're going to invest that every single month. Let me hear, is there any way to move or hide the live video of Tim? It's in the top right. No, you can't move that. Is it too big? Duncan, let me know if it's too big. Someone told me, they're like, Tim, I want to see your smile when you're talking. So they asked me to make the webcam video a little bit bigger. But at this point, it's in this top right-hand corner. That's kind of where I threw it so that I could have the chat over here. I can make it smaller, or I can change the position if you really want me to. But just let me know what you would like there. Okay, perfect. Awesome. So, and this does get into the second question. So this is from Phil. Phil wrote in, he said, I don't believe in the V-shaped recovery. So this would be the idea that the V just jumps right back up. Hold on, let me get this there. And so that hopefully you can read it now, Duncan. But that a V-shaped recovery is this idea that the chart, and this was probably, my face was probably blocking this as well. So let me move it over here. But a V-shaped recovery would be if it just jumps back up. Some people are talking about a U-shaped recovery if it kind of hugs the bottom and then jumps back up. What I'm worried about is something called a W-shaped recovery, where the fall and then bounce back and then another fall before it bounces back up. And then, of course, there's the dreaded L-shaped recovery, which is not a recovery at all, where it just goes and then stays flat and stays down for a very, very, very long time. So what Phil's asking about is there are optimistic people talking about a V-shaped recovery. He's worried that the Feds and national banks will soon run out of means to keep people in business liquid. Right? Great. It's a cool little podcast there. And if Trump starts too early, the whole thing will reignite anyway. I share those fears. Thus, my question is it still a safe strategy to invest gradually? E.g., if I have 10K, invest 3K today, 3K in 1 to 2 months, and the rest in 4 to 6 months? Or is it better to wait a month or two or so to see if things fall or normalize? So, really, it's hard for me to answer this. Obviously, if I had the crystal ball, Phil, I tell you exactly what to do. My suggestion here is that if you think that things are high, I have no problem waiting for a little bit. Now, I would assume that you already have money in the market here. If you don't have any money in the market, I would rather you get it in a little bit more quickly to do that first dart sooner rather than later. Just because, again, we don't know what's going to happen. And I would agree with you that I don't believe in the V-shaped recovery, but I do acknowledge that it could happen. That we could get rapid testing, we could get rapid, vaccines, something like this, where all of a sudden, boom, we have a medical solution. That would cause markets to jump up. So I'd want to make sure you had some exposure to that. So, if you don't have any money in the market right now, you probably do want to throw that first dart sooner rather than later. That said, if you do have money in the market, you've got darts on the board, right? Really, I have no problem waiting to throw another dart. And that I am sort of erring on the side of caution here, but with so much uncertainty, with information changing so quickly, that really I would have no problem waiting, I would say another month, right, to see where we're at. And that I do believe that in a week from now, we'll have more information. In 2 weeks from now, we'll have more information. And certainly in a month from now, we'll have more information. So if you're really worried about things and you do want to err on the side of caution, no problem to wait. Obviously, the risk that you're taking is that if it is a V-shaped recovery, then too bad, you missed it. However, if you do think you're right, if you are worried about more dominoes, and I would share that concern, then I would have no problem with you waiting another month and then reevaluating it at that point. But I would say it makes sense to have some money in the game, just because it could jump up at any point. Let me just check the chat here. Let me see here. No, not too big, but when I share the screen of the data, keep in mind, you can't see the top right. Yes, thank you, Duncan, for that reminder. It's tricky for me. I don't see it on my screen, but obviously you do. So I think that those reminders, I'll try to be conscious. I almost need to put tape over it or something to remind me. So thank you for that. Satya did ask me, is this a good time to move money invested to green funds, ETF, or stocks? So, really what I've been talking about so far is, if you've got cash, is now the time to put it to work. Satya, I think what you're asking here is, shifting things around and maybe doing, to either getting out of the green stuff or going into the green stuff. I'm not too worried about that. I wouldn't make any changes. I'm having a really hard time getting a read on how this crisis is affecting green sectors. What I'm seeing right now is that it's affecting things very similarly to everything else. So let me do this chart and hold on. Let me see if I can make the chart smaller here so that hopefully you can see the full chart here. Let me know if my face is blocking it. But this is the All Country World Index. Let's look at it over the last year, right? Things were going well, and then whoomp, right? And then the bounce back. That what I want to do is comparison, and why don't I start with that sexy one that I told Rick about? We can do smog. I'll make it green just because this is a green one. Here we go. And you can see that smog had done well. Like green stuff was on fire leading up to the crash. It was doing so well, but then it dropped a lot. And I know it looks like it because it didn't drop quite as much as the All Country World Index. But from the high, if I switch this to like a 3-month chart, right? Or let me even see if I can do, I'd rather do it just from, what is that, February 19th. So let me do it from February 19th until now, apply. That you can see that this was like the start of the crash, right? That the green stuff did fall more. Now, when we look at it in the context of over the last year, it's like, it's kind of come back to where it was in 2019 in October. So like not bad, but so much of that was because of the run up ahead of time. So, it was really disappointing for me. The first 2 months of this year, there was all this talk about green stuff and ESG, environmental social governance, and sustainable investing. This was like my prime time finally after 10 years. People were talking about this stuff. And then we get this crisis, right? And so everything just falls. What I would say is that it's too early to say whether green stuff is going to be a good bet or a bad bet in the next, few years. Personally, I think that the coronavirus situation is kind of forcing us to take nature seriously. And I'm really, really hoping that it makes us wake up and realize that just like this is a global systemic issue that we're facing, climate change is also a global systemic issue, right? And so I'm hoping that people make that connection. I'm not sure they will. And I think a big part of it comes down to this idea of how are we going to respond to this crisis once we do get that medical solution, right? And if this thing drags on for too long, I'm worried about the point that was made before, who made the point of, or I guess it was Phil's point, that, feds and national banks are going to run out of money. Because if they run out of money, there's no room for any investments in green stuff. I would view that as a bit of a luxury. However, my hope is that if we do come out of this relatively soon, if governments still do have some sort of, animals left in the barn, then what we could do is implement a Green New Deal. And just like the way we came out of the crash in the war and like World War II and the huge impact that had on the economy, right? It was stimulus spending. It was like, let's rebuild the country. Or I guess it was World War I that was the original New Deal. I'm going to have to double check my history on that. But that a lot of people are talking about a Green New Deal. And I would say there's a very compelling argument to be made for massive infrastructure spending coming out of this crisis. But that's going to depend who's in charge when we come out of it. If Trump's in charge, you won't get a Green New Deal. Biden, you might in the US. Here, I would say with Justin Trudeau, Chrystia Freeland, she just said that she wanted shovels in the ground. Chrystia Freeland, it was Catherine McKenna. McKenna, here she is, shovels ready. So she was talking about looking for shovel-ready products post-shutdown. She's now the federal infrastructure minister. So she was Minister of Environment and Climate Change. Now she's Minister of Infrastructure. So she's talking about the fact that we might get this Green New Deal. So, really what I would say to answer your question point blank is that I don't know if now is a good time to invest in the green stuff. I would be a little bit more cautious. Rick, you wanted more technology, yes, less utilities. Personally, I would prefer some of the utilities like Brookfield Renewable Energy Partners. And those, I think, are going to be better if this thing does drag on, that you're sort of reducing your low-end risk. That said, if we get this bounce back, or if things improve and we do get a Green New Deal, then that's when you would want more exposure to the technology side of things. So hopefully I answered that question. Let me see here. A lot of anxiety about a deep state control of the vaccine. The market isn't responding to that fear. I've got issues with this in terms of, the whole vaccine thing, and I'm hearing these stories about 5G causing coronavirus and, something like a microchip in the vaccine. I don't buy into that. What I sort of tweeted earlier today was a line that's been in my head for the last few days. So I'll just read it out for you. And it was basically, do not attribute to malice what can easily be explained by incompetence and hubris. Hopefully you can see this here. And that, I think that some people are really thinking that, this might have been on purpose by the Chinese government, or that there was some big plan to vaccinate everyone. In my mind, this is a case where it was incompetence and hubris. And if there is a medical solution that's going to get us back on track, I am all for that medical solution, including a vaccine. So I agree with you that there is some pushback, especially in what I would say sort of the holistic community, that there's some pushback there. I think that's completely unfounded. I don't buy into that at all. And to me, there are way bigger things to be worried about rather than deep state trying to impact us. So, we'll see what happens. Really, to me, if there is a vaccine that's available, my guess is 70, 80, 90% of people would take it. We'd get that herd immunity. If you really don't want the vaccine because you're worried that, they're going to put a tracker in you or something like that, then, you won't get the vaccine and you're putting yourself at risk. That's kind of my take on that. Yeah, so let's see here. Old New Deal, recovery from the Great Depression, 1930s, that's right. So that was it was FDR, right? So that was the Great Depression, the New Deal coming out of that, and then I think the wars continue to actually help that. So thank you for that history. I do get that mixed up. Clinton Foundation, CDC, WHO connections, again, I'm not going to go there. Yes, the world is controlled by very, very powerful people. I do not think that they are malicious. I think that someone like Bill Gates is honestly trying to do the best thing that he can to help as many people as possible. What I will say is this, that politicians and people in power never waste a good crisis. So I do think we need to be wary of people who are in positions of power using this to advance whatever agenda they have. Now, I think that sort of theory assumes that there is going to be some that these people do want to control everyone, and they're just looking for an opportunity to put trackers inside of everyone. I don't think that. I think they're looking for ways to get rich. I don't think they care what I do and want my GPS coordinates. If they wanted that, they would have it through Google and I've already basically I carry around a tracker with me. I don't know why they need one in my blood. Instead, I really look at power dynamics, and I think it's all about wealth. And so I am looking at people who are trying to make money off of this. And I do think you're going to see groups like Donald Trump and Jason Kenney, they've been scuttling these environmental initiatives, just really trying to get rid of the red tape. But they're just using this crisis where people are distracted to push forward their agenda. But generally speaking, I do think that, people are doing what they think is right. And, I'm not going to spend too much time exploring those connections. Here's this, Rick. There is an alternative, a checkmark recovery with a gradually rising exit stroke. I don't see that happening. It could happen, but personally, I think it's going to be sharp one way or the other. I think it's either going to drag down for a while like you, but I think when we get out of this, we're going to get out of this. I think that there are a lot of people ready to spend money when we do get out of this. So we'll see. We'll see how that works. All right. More questions. From Nora. So this is a good question. And again, the whole sort of market timing and looking at some of these things that people should be focused on right now. In the present climate, does it still make sense to balance equities and fixed income about the same as before the crisis? So before the crisis, my advice, I'm going to say my suggestion was 70% bonds, 30% equities for the kids' RESP. Now, which you may need to draw on in about 5 years. I was going to say your kids are older. The strategy that we do here is definitely to do, as your kids get ready for university, we want less risk, so we want more bonds. And then roughly 50-50 for a 50-year-old. Really, I don't see any reason to change these asset allocations unless something has changed in your life. So unless, there's a reason where you might need the money, anything like this, then that would be a reason to sort of switch things. In terms of education, 5 years is a little bit of, I would say, a shorter time horizon, right? So especially with things that have kind of jumped up back now, if you are worried they're going to come back down, we could go a little bit faster into bonds because you will need the money in 5 years. But honestly, even in this situation, like Nora, the fact that, 5 years from now, you've only got 30% of the portfolio at risk, that's not a huge problem. And again, who knows what's going to happen in the next 5 years. So I'm perfectly comfortable with that. In terms of a 50-50 mix for roughly 50-year-old, you can see this is, a lot of people push back on me when, I was talking about more bonds, right? So I was talking a lot about doing, a lot of people wanted less bonds. They wanted more stocks. Because bond yields were so low, they wanted to get riskier. And a lot of 50-year-olds I was speaking to were like, Tim, no way. I want to do like 40% bonds or 30% bonds. But oh my goodness, Nora, how good is it right now that we did have a 50-50 mix? That said, going forward, I think yes, unless something that has happened in your life to change your risk profile, I think that whatever allocation we had before is probably going to be fine going forward. And that really the only thing that's changed here is going to be this mix. That if you were 50-50 before, you probably have more bonds and fewer stocks now. So if anything, I would want you to rebalance and get back to a 50-50 mix. So make sure that you are rebalancing. And in my mind, absolutely, I would say, I can see Denise's little comment here, stay the course. Yes, that's exactly what I'm suggesting here, that really I don't think we have any information now to suggest that we should drastically change things. I think that, things are bad. They could get worse, absolutely, but they also could get better. So really when it comes to this question, if you're 50-50 before, stay 50-50. If you're 70-30 before, stay 70-30. You might want to, if anything, err on the side of caution. So again, with an RESP, right, we bump up the bonds by 5% each year, right? And sometimes we get a little behind on it. So if you wanted to do it a little bit earlier this year, since things have bounced back up a little bit, I would have no problem making the change earlier this year than you should. But I would really caution people against any drastic changes. All right, I'm getting lots of questions on the sidebar. So let's go here. And yeah, Rick, it was SMOG. That was the one. It used to be GEX. So I refer to that, but they changed to that clever SMOG ticker symbol. So let me get in here. Okay. So Denise, what do I think of the Vanguard Canadian Government Bond Index right now? Oh my goodness, this is absolutely sort of as kind of rock solid as we can get. So this would be VGV. This is all government bonds, right? And you can see this has done almost nothing over the last little bit. So, oh shoot, sorry, here we go. So let me get rid of SMOG. Let me just show you bonds here. Now keep in mind it looks big, but it's because this over here is a very, very small thing. Can I do like that? There we go. That looks like a little more flat, as it kind of should. Really, we saw a high of $27.78. This is as the market was crashing. And then now it's sitting back at $20, which is above where it's been for most of the last couple of years. So this is one of the safest things that you can own right now is government bonds. And what I'm going to do is compare it to my All Country World Index, which is the benchmark for stocks. I'll make the stocks purple. There we go. And so again here you can see that stocks crashed and bonds actually went up in value by a little bit. So they did exactly what we wanted them to do. Now, they did fall back down here, and again, this was a couple weeks ago, I guess about a month ago, where I was really worried because like stocks were down and bonds were down too. But you can see bonds have really leveled out, and if anything, have actually come up a tiny little bit. So Denise, as far as I'm concerned, in terms of your bond allocation, this has done exactly the job we wanted it to do in the crash, and I have absolutely no issues owning VGV going forward. I will point out that the yield on it is going to be really low. So it's not going to make you any money. It's going to be very safe. But let me see if I can just get the summary here. The interest rate on it, yeah, the yield like 2.4. The metric I look at, if people do remember, if I want the sort of specific expected return, I look at something called the weighted average yield to maturity, YTM. And let me just see if I can bring it up here. Oh, hold on. No, I'm going to have to do this. And then why don't I do this so that you can see it? And let me just see if I can find this weighted average yield to maturity. Where is it? Here we go. Yield to maturity 1.4. So this is going to earn you such a low return right now. 1.4%. It is what it is, but this is the price of safety. So in terms of the bond part of your portfolio, I'm really happy with VGV. Don't expect to make very much money from this, but this is going to be a very, very safe investment, and earning you at least, it's something. I'll take the 1.4% right now. Okay, question from Robin. I use your organic couch potato portfolio. Hooray. But I have some problem with the Canadian equity because it's too much exposure to fossil fuel and they don't even use shareholder engagement. I know. Drives me nuts. Drives me absolutely nuts. I actually have a question about it that someone wrote in, so I might be addressing this exact question a little bit later. Do I think that DRMC from Desjardins could be a good alternative? Yeah, absolutely. So DRMC... basically, Desjardins, ETFs, oops. So they came up with a whole suite of responsible investment ETFs. And so I think this is the one that you're talking about here, DRMC. So there are two of them. There's DRMC, which is the cheaper one, and then there is DRFC, which is the same thing. It is more expensive, but it does use this multi-factor approach instead of being cap-weighted, capitalization-weighted. So, I won't get into the difference between those two, but if you look at the holdings, this is going to have a lot more exposure to the bigger companies. This one's going to have more exposure, less exposure to those big companies. Let's see if I can get it, get into Morningstar, and let's see if it'll give us the carbon footprints. So what was the first one? DRMC. So let's just see if it has the data. These Desjardins ones, I haven't always been able to get the data here on Morningstar. So I'm crossing my fingers. Yes, we do have it here. So I don't know if this is going to be good enough for you. You can see carbon risk score is still quite high, lower than the average for Canada, but it's still really high. And fossil fuel involvement, holy crap, 22%. Again, less than the benchmark, but still very, very high. The Janssy Social Index, if this is why you didn't like it, then, I don't know if that one's going to be the right. Let me just do the quick little comparison here. Yeah, so, okay, the Janssy Social Index is higher than average. Wow, that drives me nuts. So at least the low carbon footprint one is below average, so it would be a step in the right direction. And then let's just do a quick little look at the DRFC, which uses this multi-factor approach, which there's this whole theory around factor-based investing, this Fama-French 5-factor model, which, so instead of just having the largest companies, it would include the companies with the sort of that factor approach embedded. And it does look like it's got a lower fossil fuel involvement, although a higher carbon risk score, I think, which is fascinating. But to me, this one, the fossil fuel involvement, because it would be lower, that would probably be the best bet for you. I would almost suggest though to like hold your horses because RBC iShares ETF filings, there might be one that comes out very soon. And here it is. This is the announcement. So it's not out yet, but RBC iShares is expanding its sustainable ETF offerings. And you can see here that they are going to have this iShares ESG MSCI Canada Advanced ETF. And I'm pretty sure it says here, will exclude issuers with material involvement, including fossil fuels, among other citizen stocks. So they're saying it's going to be fossil fuel free. I don't know how fossil fuel free it's going to be. I won't know until it actually comes out. But I would say that this is likely going to be the best way to get exposure if you're looking to lower that fossil fuel in Canada. There's one from BMO, SG ETFs. Let me just see here if I can get it quick. I believe it's ESGA. So this one is out. ESGA, I think it is. So this is another one that you could consider, the BMO MSCI Canada ESG Leaders. It will still have fossil fuels in here. It just might not be as much. We'd have to look it up. You can see Enbridge, very heavy. I think Suncor still gets in here as well. Yeah. So let's see if I can bring it up on Morningstar. ESGA, which is this one. I don't know. It hasn't been around for a full year yet. So I doubt I'm going to get the data here on Morningstar. But let's check. Yeah, I don't get the carbon data yet, because it hasn't been out for a full year. But, again, I don't think it's going to be great. My instinct for you is to wait for the RBC iShares one. As well, the other thing that you might consider is that Wealthsimple has also filed. So we're going to keep an eye on this. That Wealthsimple is entering the market, and they filed prospectives for 2 of them. It wouldn't be Canadian equity. Instead, it would be North America equity, which includes Canada. So it'll be like Canada and the US. This is my way of saying that, like organic couch potato, that's really evolving. Janssen Social Index, that's like the oldest Canadian equity one. So that's why I had it in there. But there are new Canadian equity ones coming out all the time, and you can just plug and play those from the model portfolio. Really the goal there is Canadian equity exposure. You can choose the best one. As well, it's possible that we might end up doing, with this Wealthsimple North America, plus this developed markets ex North America, that would be 2 ETFs, although it wouldn't have emerging markets. So you can really plug and play there as long as you do get that exposure when it comes to the Canadian market, plus the US market, plus Europe, Australia, Far East, which is developed, plus emerging markets. We really do want that global exposure. I know this question was asked by here. Yeah, look at this. My timing was great. So from Vincent, you've been great. Any news on Wealthsimple that were new to Dawn? I don't have an update. To me, this is really, again, I'm just watching. I think it's a hard time to launch an ETF, but I'm watching for Wealthsimple and I'm watching for RBC iShares. And, fingers crossed, we'll get to see them soon. I just don't know when. In terms of the new ETFs that I'm excited about, really the only thing that I've seen that to me is really, really cool is going to be this from BMO. They did something really cool, which is ESGG. And this is the first version of an all-in-one. And so what this is, again, they came out with a whole bunch of ETFs, including a USA one, EAFE, which is Europe, Australia, Far East, and a Canada one. And what they did is they put them all into this one ETF. And then as well, they did, I think it's ESGZ, I want to say. No, which one is it? Give me a moment here. ZESG. Oh, I was so close. Here it is, ZESG, where what they did here is not only that mix of USA, EAFE, Canada there, but they also have government bonds. They also have some corporate bonds in here, as well as a little bit of US corporate bonds. Now, the way they've done it is it's about 40% bond. So I add up, what is it? This 14 plus 10 is 25. So actually it looks like about 30, plus this guy. So it is about 40% bonds, 60% stocks. But this is like basically my Canadian couch potato in one ETF. You could just buy this. Now, it doesn't have the green stuff, so it doesn't have the clean tech ETF that I like. This would just be like doing less evil. But you can see I'm kind of excited. The idea that this would be like an all-in-one ETF, that these have been really popular among traditional investors. But this is the first one I've seen globally, and it's here in Canada by BMO. That's sustainable. The first one I've seen that is sustainable or that's an ESG ETF. So to me, this is probably the thing I'm most excited about. I've got feelings, some good, some bad, about the methodology that they're using here. It's not fossil fuel free. But what gets me excited is that this is the first like all-in-one ESG ETF. And I'm really hopeful that there are going to be more of these released in the future. Okay, let me go back to the chat here. Okay, here we go. Yes. So basically, Robin, do I think that DRMC could be a good alternative? Yes, I do think it would be a just fine alternative. But personally, if I were you, if your issue is fossil fuel exposure, I would wait for those new ETFs from RBC iShares or Wealthsimple before making the switch. Okay, here's Gal. Knowing there will be economic consequences for some years on the real economy, what do I think about impact investments like CoPower and CSI bonds regarding the capital invested for investors? Oof. So I really want to do a whole episode on impact investments. I really do. I think that would be awesome. I'm really excited about these, and I really want to explore them deeper because each one is going to be so different. CoPower is going to be very different from CSI. Now, I don't have any inside information here at all, but I do have my instincts. And so you're asking me what I think, so I'll give it to you. I feel like CoPower is in really good shape. When I look at their project portfolio, I feel like these are things, it's almost like a utility. I'll make it a little wider here. Hopefully I'm not covering too much. But, residential geothermal in Toronto, in Kelowna, community solar projects, again, not the technology, but the projects, and the condo LED retrofits. Really, I would say here in terms of dominoes falling, the thing that I think could hurt CoPower is if a condo, like a condo board, I don't think that could happen where like a condo board goes bankrupt and that contract would be canceled. I can't imagine. And I would hope they would have legal provisions like insurance or something like that. If that happened, I think it's much more likely that the people who own the condos might end up going bankrupt and that the value of the condos could come down. I really doubt there would be an issue with the condo board itself, but that's who they've signed the contracts with. So I feel really good about CoPower. I think that these projects are, great. I think that they're very solid. I feel that this is more like a utility approach, which is why I have no problem with CoPower. It would be interesting to have them on and to actually ask them, has this changed the outlook? Has this changed some of the situations? What I like about it right now, from my mind, is that, I like the 4% return over 5 years before the crash, right? This 4%, I was like, yeah, I'll take 4% for this bond. I like it even more now. Now that interest rates have fallen, this 4% is sweet. And if you had one of the old CoPower bonds that was paying 5%, 5% right now is very sweet. So to me, these have held up quite nicely. I do still feel very, very confident about them. The other one you asked me is Novation.ca is, CSI Toronto. So the Center for Social Innovation.org, I got it wrong. So really, in terms of CSI, I'm a little more worried about them. I'm not going to lie. I think it will be interesting. And again, I would love to get Tanya, or I would love to get, some of the people from CSI in here to really help me understand how they're dealing with it. I am a CSI member, so they did send a letter. It's obvious that a lot of CSI members can't pay their rent. I'm able to, so I'm still paying 100% of my rent to CSI, even though I'm not using it. The thing that they're missing out on from me is I'm not booking any meeting rooms. So I used to spend a fair bit of money on meeting rooms at CSI. And obviously I'm not booking those, I'm not paying for those right now. But I do think that their revenues are going to be hit really hard by this. And in all honesty, I don't know how badly they're going to get hit. That said, I feel that this is such an important institution here in Toronto that I do feel that members and community would step up. And one thing I know about nonprofits is that nonprofits are much less likely to go bankrupt. That they're going to fight tooth and nail to prevent bankruptcy from happening. Whereas a lot of companies, private companies, profit-minded companies, a lot of them are happy to go bankrupt. That they'll just, we're underwater, it doesn't work. No, okay, we're going to go bankrupt. Sorry, investors. Whereas nonprofits don't do that. They fight. So I will say that I feel a little bit more nervous about the CSI bond. And it's mainly for two reasons. Number one is that I'm worried about their revenues and their cash flow and how they're going to keep paying for all their expenses and all their staff, which don't go away, when I imagine a lot of their tenants aren't able to pay their rent right now. And number two, I do worry a little bit about real estate in Toronto, specifically commercial real estate. That, as we come out of this, I don't know, are restaurants still going to be a thing? Are people going to want to eat in a crowded restaurant? Maybe, if we have a vaccine, then sure. But if we don't, or if it's not a perfect vaccine, there's a lot of question marks there, where it wouldn't surprise me if commercial real estate ended up being one of those big dominoes to fall. And so my concern here is that, I do know that CSI, that they valued their building, that they got it appraised in anticipation of the community bond, and they got the value of their building went up because it's Toronto real estate, and all Toronto real estate went up by so much. What I don't know is what that value is going to be on the other side of this. So I would say I'm a little bit more concerned with CSI. It pains me to say it because I love them so much, and I'm going to do everything I can to support them. What I would say is that the impact of the CSI community bond has gone up, that I think that they kind of need it, and that the impact of, being able to get through this is really, really important right now. That said, if I'm looking at it, wearing my economist hat, looking just at the profitability, I gotta say there's definitely more risk in this bond than there was a month or two ago before the crisis. So that's kind of my honest assessment there. Okay. Oh, Robin. Oh no, I didn't catch all your questions. Hold on. Here we go. What do I think about XESA instead of ESGD and XESM instead of ESGE because they're in Canadian instead of USD? So this is, again, the couch potato. I feel like I kind of addressed this already. I've got no problem with these two, but if your goal is fossil fuel or low carbon, these aren't going to fit the bill. So again, I would wait for the new iShares and the new Wealthsimple before you make the switch. In terms of Denise, would you say stay the course with investments, i.e. keep putting cash into investments, or hold cash right now? So again, this is a really, really tricky question. I'm going to come back to my questions that I wrote at the top. And Denise, straight up, I know your situation a little bit. And it's is your income affected by the crisis? And, it wouldn't surprise me if it did, that, you're seeing less income right now. I don't know that for sure. But if your income is affected by the crisis, and yes, it is, keep cash. Number two is, do you have debt or an emergency fund, right? If you've got debt, keep it in cash. If you don't have an emergency fund, guess what? You need an emergency fund. Keep it in cash. Or if it's not for the long term, if you're thinking that in the next few years you might, want to buy a rental property or invest it in your business, or, quit your jobs and go traveling all over the world, right? Hard to imagine that right now, but it could be your plan. That if it's not for retirement, if it is for, just looking at a place to park money for the next few years, then, keep it in cash. Really, only if you check all of these boxes, that your income is unaffected, that you've got your emergency fund fully topped out, and this is really for retirement, for long-term savings. If you've ticked all those boxes, keep investing. It doesn't matter if it goes down, right? You're fine. You're in good shape. You can wait for it to come back. And that, in fact, this could be a good time to invest. I don't know. So really, it's going to come down to these questions. If you feel good about all of these things, then absolutely what we want to do is keep investing right on schedule, stay the course. But, if your income's affected or you're worried that it might be in the future, again, some of these times these things are a little tricky. We don't know what's going to happen. If you're in debt or you don't have a fully funded emergency fund, keep it in cash. Or if it's for the short term, if it's not for retirement, keep it in cash. Hopefully that answers your question. Okay, John. Hello, Tim. If the Canadian dollar is not very good right now, but I need to rebalance in my USD ETFs, should I wait? Okay, so this, someone else asked about currencies. So let me bring up this question as well, because it's nice to answer them both at the same time. Here we go. So this is from Kenneth. The Canadian dollar is plummeting 71 cents US due to low petroleum prices and the COVID-19 recession. Where do you believe it is ultimately headed? Should we put any money into stronger currencies like the Swiss franc? So first of all, I want to be clear here that, yes, the currency is very, very weak. Let me see. I think I can get the chart. You know what? Let me go to xe.com because I know I'll be able to get the chart here. So when I bring up the chart, I want, yes, this one. And then I want to be able to give me the chart. Hold on. Here it is. We'll view full USD to USD chart. Here we go. So I want this. Oh, it'll only give me 10 years. So in this case, let me do the inverse, just because we're saying that that it's low right now. So to keep it simple. So remember 10 years ago when it was like in about parity. And then it did come down all the way down, right? And then it kind of came back up, and then it was sitting, right around 76 cents. You can see the price up here, 76 cents. And then, here's where it really did fall. Oh, chart looks a little wonky, but it did fall down here about 25th of March, 69 cents, 70 cents. It's been kind of right around there. Now, I wish I could get one that went back further. Let me just see here if I can. The historical chart. Because, this whole idea of it like plummeting, let me see if this gives us longer than 10 years. I don't allow. Yes, I am using an ad blocker. Hold on. From 1953. I kind of like this. Let me see if I can do this. Wow, this is an interesting one. USD, CAD, since, let's do all. Let's see what this looks like. Here we go. Wow, look at this chart. This is very, very ugly. Okay, and I want to do it as the reverse because that's what we were looking at. So I do just want to give a little bit of historical context here, right? That it has been lower. And I don't think it's going to give me the exact date of when it was lower, but it has been lower in history. The lowest it's ever been is 0.61, so 62 cents, right? So right now we're at about 71 cents. So it's low, but it has been lower. So it has plummeted, it has gone down. I agree with you. Really not as much as it did a few years ago when the oil market crashed in probably 2015. That's when it really went from parity down to quite a bit lower. And then it did go lower from there. So, this is my way of saying that, historically, I don't think we're super far off the mark. Where do I believe it is ultimately headed? I have no idea. That really, I don't have that crystal ball. And this is one of the things that's going to be the hardest to guess because it really depends on interest rates. And it also depends on inflation. And that I would guess that we're going to have similar interest rates and similar inflation as the US, which is why I would say it's probably going to stick around here for quite a while. That would be my guess in terms of the crystal ball. Now, in terms of John's question, his is a little bit different because it's not about, where's it going? Should I do Swiss franc? Honestly, when it comes to currency exchange, I would say a coin toss. I don't know enough about the Swiss franc to know whether it's a more stable currency. I don't know how bad coronavirus hit in Switzerland and what other factors might affect it. So unfortunately, I'm just not a currency buff, so I can't really speak to that. What I can speak to is the need to rebalance US dollar ETFs. So this is a good question, John, but it's a little misleading, because I want to be clear here that, like, oftentimes, so like, let me go back to the question here, where it was asking about, the US dollar versus Canadian dollars. So XSEA, let me just show you here, XSEA ETF. So this is going to be an EAFE. Look, the iShares EAF, ESG, MSCI EAFE, Europe, Australia, Far East ETF. This is traded in Canadian dollars, right? But it's got a whole bunch of European holdings. So when we look at what's in here, you can see, oh, shoot. Nestle, this is a Swiss company, so those are going to be Swiss francs. Roche Holding, this is French, so that's going to be euros, right? So this is going to have a lot. Let me see if I can do, hold on, exchange. Yeah, look at this. So now, hopefully you can see this. Swiss exchange, Euronext Amsterdam, right? All these different exchanges. So we're going to have exposure to all these different currencies, right? And what we're going to do is, hold on, give me 1 second. I'm just going to close the door. All right, I'm back. So, really when we buy, even though this is in Canadian dollars, I want to be clear that we're getting exposure to all these European currencies. That's what we're doing. That even though this trades in Canadian dollars, we're owning these. Versus, the other one, what was the other one? What was it? SEGD, I'm going to guess. SEGD, that was right. ESGD rather. ESGD ETF. So this is the same ETF, but traded in US dollars. Right? So you can see here, it doesn't have the currency because Americans are so arrogant. If there's no currency, you just assume it's in USD. But again, it's going to have the exact same things inside of it. Nestle, Roche Holding, SAP, again, these are going to be traded. Look, this one lets me do the currency. But look, they're trying to do everything in USD here, right? But when we look at the exchange, it's going to be the same exchange. So when we chart them, this is my way of saying it really doesn't matter. Let me go back to Yahoo and let me just show for you ESGD. This is the one that's in US dollars. Let's look at the chart. Let's look at it over, let's say, the last 3 months. I'm going to get rid of this guy, right? So here we go. From there, I'm going to add to it. And what was the symbol? I forget the new one. XSEA.TO. And since this one's Canadian, in Canadian dollars, I'll make it red. And you can see, whoa, these are the same exact ETFs with the same exact companies. But look, there's a big gap in the performance. And this is because when we put all of those currencies into Canadian dollars, they're worth more Canadian dollars right now. Whereas when we put all of them into US dollars, they're worth fewer US dollars. The US dollar has gotten stronger. So I want to be clear, this is the same ETF, two different currencies. And this is a great way of illustrating that, honestly, John, right, that it really doesn't matter what that currency exchange rate is right now. That currency exchange rate, the fact that the Canadian dollar has fallen, has gotten weaker, is already embedded in the share price of the ETF. So this means that I don't care what currency the ETF trades in. What I care about is the exposure, the currency exposure of what's actually inside the ETF. And since these have the same exposure, really it doesn't matter to me whether we buy the Canadian dollar one or the US dollar one, right? Because if you keep it in Canadian dollars, right, you'll be able to buy more of them. Or sorry, you'll be able to buy fewer of them because the share price is higher. if you take that Canadian dollars and convert it into US dollars, you'll lose on the currency exchange, but then you'll gain because you're actually paying a smaller price, a lower price in US dollars for those same stocks. So really, this is my way of saying is that when it comes to rebalancing your portfolio, don't worry about the exchange rate. Just don't worry about it. If you wanted to play the currency or do anything like that, we could talk about currency hedges and different ways of getting exposure. You could look at what your allocation to US stock market is, because that's going to be exposure to the US dollar. But really, you don't need to worry about it in terms of rebalancing while the dollar is weak. If you rebalance while the dollar is weak, that's fine. You won't get as many US dollars, but that means the US dollar is strong. You're going to be able to buy more of those shares. Hopefully that answered your question. Okay, somebody has a perfect, yes, I know, isn't this SMOG, the ticker symbol? VGLT has been great, so yeah, and this would be back to Denise in terms of the, that government bonds, right? This would be very similar, right? You can see why, bonds are an important part of our portfolio, right? Some people push back on me on that. Now they'll get that. John, you did have a follow-up question. Great. Just as a follow-up, how much of my equity would you say I should have in USD or CAD? Again, doesn't really matter. I can't speak to the percentages. Really, use the best currency that makes the most sense for you. If you don't know, if you are going to be exchanging more than 10K at a time, you might consider using Norbert's Gambit. So this is a trick I've taught a lot of people. So if you do have a lot of US dollars, you can do that. But again, I really don't care how much is in USD. Instead, what I care is how much is US equity, right? And then again, when it comes to a standard portfolio, sustainableeconomist.com, I've got my model portfolios. Oh, I spelt it wrong. Hold on. Sorry, me and my spelling. It's hard to spell under pressure, I'll tell you that much. But I've got these model portfolios, so obviously it's going to depend on you. But if I look at my organic couch potato, this is something where this is a 60-40 portfolio, right? So 60% stocks, 40% bonds. Here I've got 15% to US, right? That's fine. That might be a little on the small side. This one has a home bias, so it's a little heavier on Canada than I normally would. But for example, if I do the Vanguard one, you can see here that this is a much simpler one, but this has 30% exposure to the US stock market. So, these are both in US dollars, right? So it's 60% is in USD. I don't care so much about that. This international one is going to be exposed to all those international currencies. It's only this part that's going to be exposed to US dollars. So hopefully I was able to get that context through. Onana, thank you for being here. What's my opinion on renewable gas and Enbridge waste connections? Existing pipelines won't be abandoned. So I can't really speak to natural gas too much. Certainly, I think natural gas is doing a lot better than oil is right now. I have a lot of negative feelings around oil, not so much around gas. But to me, I absolutely have my concerns here. I agree with you that existing pipelines won't be abandoned, but the price of oil is going down so much. We looked at it way back when. There is talk, they have filled up all the reserves, and they are talking about the possibility of having a negative oil price. If you've got a negative price of oil, I don't know if you're going to pay to ship that, right? I don't know how you make money in that scenario. So to me, I'm a little bit more nervous about pipelines, especially oil pipelines. Natural gas, different story. I think that there's less likelihood that that's sort of, going away or being as impacted there. And something like waste connections, I would assume that this is like biogas or something like that. I've got no problem there. So when it comes to nat gas, I don't love it. I don't hate it. When it comes to oil pipelines, I would be cautious. This Keystone XL, the Alberta government put so much money into that. And then now it's being held up again. I don't know if those are going to go through. So I'm just going to, I would be worried more on the oil side, less on the natural gas side. but I haven't really paid much attention to it, if I'm honest with you. What's my take on DRFG? Oh man, Daniel, I could write a book about DRFG. DRFG, I do like it. In my mind, if we can open it up real quick. It is fossil fuel free, but actually let's see if I can get it on Morningstar right now, because I wonder if it's up. I tried looking it up on Morningstar and it wasn't there. I couldn't get the data, but I wonder if it's past that now that it's more than a year old, whether I can. Let me just see here. But basically, when it comes to DRFG, this is the Desjardins RI Global Multi-Factor Fossil Fuel Reserves Free ETF. It does a really good job of getting rid of most fossil fuels, but it still has natural gas in here. Darn it. I don't get the carbon risk score. That's too bad. But I did have someone go through and do the analysis, and what they did is they looked at all the holdings, and that there are some natural gas utilities in here. So really what I would suggest you do, is we can go here to the Desjardins website, you can look at it, and Daniel, what I would really suggest is looking at the holdings. And we can go inside the financial data, and we can look at the holdings, and I want all of them. And there's going to be something like 850 holdings or something in here. So I'm not going to take, look at this, 906 holdings. So let me make this a little bit bigger. And that, it's going to have stuff in here you might not love, like Walmart. It's going to have, I know, things like usually Nestle is in here. Oops, sorry, I misspelled that. Oh, Nestle is no longer in there. That makes me happy. But if I look up gas, no, hold on, energy, I'm curious, no. Okay, I know they're hiding out in here, the natural gas utilities. I don't know any of the names off the top of my head. Some of the other problem companies that were in here, I'm just trying to remember what they were. If Nestle isn't in there, here's Pfizer. I don't know how people feel about Pfizer. Where was it? Oh, Nestle is in here. I must have spelt it wrong. But Nestle is in there. I was right. What else? Like Tiffany. Okay, I'm not loving that company right now. Dow, which is, where is it? It was, hold on, sorry. I'll use these guys. Here it is, Dow. So this is going to be chemical companies, right? So that is going to be a problem. I don't know if Bayer sneaks through. Okay, thankfully Bayer, which owns Monsanto, is not in here. So this is my way of saying I like it. I really like it. It does do a better job of tracking the performance of the All Country World Index. So if you remember ACWI, if this is like my benchmark, right? And then I'll get rid of this one. And then if we look at it over the last year and I add it to DRFG, and let's make this one green because it's Desjardins, so it's green. You can see that this has done a very, very good job of tracking it. Now they are in different currencies, so remember, that would have an impact here, but you can see it does a really good job of tracking it. So to me, it's like this is going to do a better job of tracking than something like ETHI, which it wouldn't surprise me if you're asking if this is the one that you own. You can see ETHI has done really well for us, so it has performed better. I don't know if it's going to keep doing that, but you can see that it did deviate. Like it came up a lot more and then it fell a lot more. So, DRFG is going to do a better job of tracking the standard benchmark, but there are going to be some companies in there that you might have problems with. And so it's going to be up to you whether those are deal breakers or not. Okay, VGLT, yes. Time to sell, no, definitely not. Those are government bonds. We can do that. Okay, have I heard about dark pools? Are those good and bad? I assume like dark pools of money. I can't speak to that. I feel like, again, that would be something that I'm just not an expert in. So let me maybe look at this a little bit, but I can't speak to it right now. One more question on the email about registered accounts. Oh no, did I miss the registered? Oh, thank you. Best impact investing options that are eligible to be held in registered accounts. Thank you, Satya. So this is really, the only thing here would be CoPower. That's the one that I know we've gotten into RSPs and TFSAs. Sadly, it is sold out right now at the moment. So some of the other ones you might be able to do it, but it can be a little bit of a pain. Solar Share, I think, is still selling bonds. But again, I'd like to do a whole show on impact investing. So maybe I can leave it there. Okay, thinking those were bonds. I was thinking growth, and yeah, no problem. How do I feel about Solar Share right now? I feel good about Solar Share. Honestly, their projects are just humming along. They're selling into the grid at those very nice purchase power agreements right now. No work concerns about Solar Share. I would say I would like to bring them on the show. I don't know. I feel like they're about to sell out. I don't know. Bonds.ca. I haven't looked at it for probably a couple weeks, so I'm just curious if they are still selling bonds. Yeah, still say on sale. So my guess is they're going to sell out soon. I don't know if they're going to tell me when. Yeah, it's interesting. So, and this is interesting that they are doing the next step. So, I got no issues with Solar Share. My guess is that they are going to sell out fairly soon. Thoughts on ZLB for Canadian ETF to get away from fossil fuels. Let me just bring it up real quick. ZLB. I don't know this one off the top of my head. ZLB. Low volatility. Okay, interesting. So curious. Okay, cool. So I don't know this one too well. It's got a low volatility. It might be low fossil fuel, but I don't think it has a mandate, which means that might change. Let me just see if I can find it. Oh, shoot. I had it there. Here we go. So let's see if I can get the data on it. But with a lot of these more active ETFs, so this would have a low volatility, sort of active skew. So yeah, you can see here, less carbon risk score, less fossil fuel involvement. But it's still going to have them in there, obviously. And that because it's got this more sort of active approach, where it is looking at low volatility, this means that they're not doing it deliberately. I want it through BMO. Hold on, here it is. Oh no, this is going to be taking me to this website. So annoying. Hold on. I hate the BMO website. ZLB, here we go. Here it is. So when we look at what's inside of it, we'll see here, okay, yeah, countries here, and Brookfield Renewable, there it is, right? Not a huge amount of fossil fuels. Great. It's going to have some, like I showed you, it's going to have some TC, TransCanada, which is a pipeline, right? So it's going to have some in here for sure. But the issue that I have is that my guess is if we look at the overview, it'll tell us. So provide exposure to a low beta weighted portfolio of Canadian stocks. So beta is a measure of volatility. So what this tells me is that if the volatility measures were to change for fossil fuel sectors, that they could get more exposure. So in my mind, this is an ETF that might be a good fit for now, but there's no way I can promise that this is going to be low carbon going forward. As a result, since I tend to look at ETFs where I don't have to think about it, where I just set it and forget it, right? That to me, this is one that I would need to keep my eye on a little bit more. So I would rather go with one of those Desjardins low carbon ETFs, or I would rather wait for the RBC iShares or Wealthsimple ETF. Okay, we're getting on 8:30 here, so I'm gonna need to go to get out of here at some point. Denise, thank you so much. Oh, I'm so glad people appreciate it. It's great. Drop off Lyra and Good Impact Investments. No problem. You can email me. Yeah, methane leaks from gas wells. I did not get into this at all. So, absolutely, there are some huge environmental issues with natural gas. I just want to see if there are any questions I didn't get to here. Okay, there's one last question I'm going to do because I have got questions from two Kathys. And I'm going to keep them here. I'm going to answer these questions and speak directly to Kathy so that I can email both of these Kathys and then get it back to them. So what would I suggest is a good resource for identifying the top global environmental funds in terms of performance and size. I'm looking for environmental, not ESG. So the best resource that I have for you is the Corporate Knights list. So I think I had it, here it is. So Corporate Knights, which is a resource that I love and I write for them. I might be on their website here. Here I am as a columnist for them. But they publish this list. And this is like the list of both ESG but also environmental funds. And I can just point out the ones that you should look at. Societale Positive Change Fund, McKinsey Global Environment Fund. What are the other doing more good ones? Environmental Leaders Fund from NEI. I love this one. Desjardins Societale Clean Tech Fund. These are all in Canadian dollars. And I'm pointing out the ones that I think are like doing more good. Those are the ones, AGF, Global Sustainable Growth. Great fund there. So you'll notice there are no ETFs on the list. To my knowledge, there really aren't many sort of doing more good ETFs, Canadian dollar ETFs. The only one I know is CESG, which is this MSCI World ESG Impact ETF. So you could look at this one. All the other ones are mutual funds. One that I don't know if it was on here. Did it have McKinsey? Yeah, McKinsey Global Environmental Equity Fund. Love this fund. So this has all the mutual funds. You might want to consider looking at CSG. The problem I have with this is that Corporate Knights does this really funny sustainability score metric that drives me nuts. And I'm not the only person it drives nuts, because from another Kathy, she said that iShares Jansi Social Index ETF rates high on the Corporate Knights list of sustainable funds, but 5% of its money is in Suncor, which makes it hard to accept. Does it rank high because it is so good in other spheres, or is there another reason? And the short answer for me is I'm not sure. And maybe I can get Toby Heaps on here to be able to speak to this and the methodology of how they're actually coming up with this. But it is amazing to me that something like Jansi Social Index scores so high, or that DRMC that we had looked at earlier scores so high, even though it's got a lot of fossil fuel exposure. Where something like the Global Environmental Fund, actually this has a pretty high score, 98.4. I guess they're not in the, and Jansi Social Index 99.4, like wow. And it could be that maybe it gets a high score because it's got the financial score. It's been around a bit longer, right? But, something like the NEI Environmental Leaders Fund, pretty good, but like not as high as the Jansi Social Index. So I can't really speak to the score here. I would need to bring on Toby Heaps to help him sort of walk you through that methodology. Personally, I don't agree with it. And I would definitely put a lot of these like doing more good funds, ahead of something like the Jansi Social Index. But it is what it is. Really what I would say is I would use this, like I do, as a directory of all the different options. And then, buyer beware. You're going to have to sort through the funds, and you're going to have to figure out which ones make sense for you. So hopefully that answers your questions, Kathy's. I do think there was another question here. Wesley, dividend ETFs like ZDV. I'm not a huge fan of these dividend funds. I mean, if you really want dividends, if you're like in retirement and you want dividends, then great. I'm not a huge fan of them. I don't think there's only one ESG dividend ETF. I feel like there's one in the US. Yeah, from ClearBridge. Here it is, YLDE. So this is going to be the ClearBridge Dividend Strategy ESG ETF. But really, like the only reason, Wes, that I would want you in a dividend ETF is number one, if you were like living off the revenue, like you were in retirement and you like needed that money to live off of. Or number two would be to, something like the Canadian dividend tax credit that, you really wanted to be like tax advantageous. And so let's do like a Canadian dividend ETF. But really, my understanding is that, whether it's from dividends or from growth, like money is money. So if it's paying higher dividends, that means less growth. And so the only reason I would really want to make that sacrifice is, number one, Canadian dividend tax credit. If you're doing it for tax reasons, okay, I understand there's a strategy there to have lower taxes. Or number two, if you're like need the cash because you're living off the cash. So for me, I'm not a huge fan of those dividend ETFs, but I do get it. Thanks, Tim. Will you be going back to Bloomberg? We could go for hours. I know, right? We absolutely could. We'll see. I don't know. I don't know if I'll be getting the Bloomberg terminal. I don't think I'll get one anytime soon. Too expensive. Otherwise, really, this has been a great show. My dog is doing great. Ronald, thank you so much. She didn't come visit today. I don't know. She came in, she popped her head in, and then went right back out. So we didn't get a visit today. We weren't graced with Iri's presence. But thank you so much, everyone. I'm so glad this is helpful. I'm glad you're getting a kick out of it. If you're still around, it means that you do love what I'm doing. So don't forget to subscribe, and sort of ring the little bell so that you get the notifications from YouTube. And thank you so much, and I'll look forward to seeing you again next week. All the best.